Silver's explosive rise. What you need to know, silver just did something extraordinary. Right before Christmas, it closed at $72 an ounce. The next trading day, it shot to $75. By Friday, it rocketed to $79, nearly hitting $80 before the market closed. Since December 1st, silver has increased by $20 per ounce. At this rate, we're looking at $100 plus silver by the end of January. But here's what's really interesting. Legendary monetary expert Jim Rickards just predicted silver will hit $200 per ounce before the end of 2026. That's nearly a 3x return from today's prices. However, there's something critical nobody's telling you. Despite this explosive move, 99.9% of people who think they're protected by owning silver will still lose money. Not because silver fails, but because they fundamentally misunderstand how to own it. In the next few minutes, I'm going to show you what's really driving this unprecedented rally, why this time is genuinely different from 2011 and 1980, the systemic crisis that gold is screaming about, and most importantly, how to position yourself correctly so you don't become part of that 99.9%. Let's get into it. Part 1. This is not 2011. This is not 1980. Many people watching silver's explosive rise are nervously asking, isn't this just like 2011? Won't it crash and go sideways for a decade? Here's why this time is fundamentally different. In 1980 and 2011, silver spiked due to speculative mania, then crashed hard and moved sideways for years. But what's moving silver today is not what moved it in the past. There are 3 structural differences that have never existed before. First, physical market backwardation. Physical silver is currently trading higher than futures contracts. This means the actual metal in your hand is more valuable than paper promises for future delivery. This is not normal. It signals severe physical shortage, and this condition hasn't been sustained like this in modern history. Second, the China premium. Silver prices in China are running $3 to $5 higher than prices in the United States. This unprecedented price disparity reveals massive demand that cannot be satisfied. When the world's largest manufacturing economy is paying premium prices for physical metal, that's not speculation, that's structural shortage. Third, deliverable silver crisis. We're seeing global delivery issues across major markets. More silver is being consumed industrially than is being mined, and this gap is widening every year. Unlike 2011, which was driven by investment demand that could evaporate, today's demand is structural and permanent. Here's the critical insight. Even if silver experiences a 30 to 40% crash tomorrow, it would still be priced dramatically higher than it was in summer 2025. The fundamentals supporting this move are that strong. But to truly understand where silver is going, we need to understand what gold is telling us. Because gold is flashing a warning signal that has never been wrong in 50 years. Part 2. The warning signal everyone's ignoring. Gold has surged 50% over the last 12 months. That exact pattern has preceded every major financial crisis in modern history. 1973, gold jumped 50%, brutal recession followed. 1980, gold surged 50%, another recession hit. 2008, gold climbed 50% in 6 months. Then the financial system collapsed. Now, gold just did it again. And this time, the contradiction is bigger than it's ever been. The economy looks fine on paper. Stock markets are at all-time highs. Unemployment is near record lows. GDP is growing. Every traditional signal says we're good, except one. Consumer sentiment is at Great Depression levels, lower than 2008, 1990, 1982, or 1974. Think about that. In all those previous years, the economy was actually in trouble. Unemployment was high. Markets were falling. People felt bad because things were bad. Today, the stock market just had one of its strongest runs in history. Yet people feel worse than they did during the financial crisis. This is what economists call a K-shaped recovery. The financial system is soaring in one direction while the real economy sinks in another. And the gap between them has never been wider. Gold knows this. Gold always knows. Here's why this matters. For the first time in modern history, U.S. federal debt is now larger than GDP. The government owes more than the entire economy can produce. When debt reaches these levels, there are only 2 options: default or inflate your way out. Governments never choose default. They always choose inflation, print more money, devalue the currency, and quietly make everyone poorer. This is exactly the environment where precious metals historically perform their most important function, preserving purchasing power while paper currencies collapse. But there's something bigger happening. Central banks worldwide are dumping U.S. treasuries and buying gold at record levels. China, once the largest holder of U.S. treasuries, has been selling them for years while buying gold. Russia, cut off from global banking through sanctions, doubled down on gold. India is stacking gold and silver at unprecedented rates. In 2022, central banks bought 1,136 tons of gold. In 2023, they bought 1,037 tons. These are the two highest years on record. Why? Because gold and silver can't be frozen, can't be sanctioned, can't be printed away. They don't depend on anyone's permission. When the world's reserve currency starts losing trust, everything priced in that currency loses value. Your savings, your paycheck, your retirement account. Gold isn't just predicting an economic crisis. It's predicting a global realignment, a shift away from the dollar as the world's reserve currency. And where gold goes, silver follows with even more explosive potential due to its smaller market size. Part 3. Why 99.9% will lose, and how not to be one of them. Now here's the brutal truth nobody wants to hear, but it's the most important part of this entire video. Most people lose money in precious metals not because they choose the wrong assets, but because they fundamentally misunderstand how to own them correctly. Let me be clear. Owning silver does not automatically make you safe. How you own it, why you own it, and what you do when panic hits, that determines whether it protects you or destroys your wealth. Mistake number 1. Emotional decision-making. Most people enter silver at the worst possible time. They buy when prices are already rocketing and fear of missing out takes over. At $75, it feels safe because everyone's doing it. The price is going up. Experts are being quoted. This isn't strategic investing. It's emotional reaction. But markets never move in straight lines. When silver inevitably corrects, and it will correct even in a bull market, psychology shifts dramatically. What felt like a smart move at $75 feels like disaster at $55. Fear replaces confidence, and people sell at the absolute worst time. The irony is that precious metals often perform best after periods when sentiment is most negative. When everyone gives up and declares them dead, disciplined investors start accumulating. The majority panic sells at the bottom, right before the next leg up begins. Mistake number 2. Paper versus physical. The dangerous illusion. Here's the most critical thing to understand. The ratio of paper silver to physical silver is approximately 100 to 1. For every 1 physical ounce that actually exists, there are about 100 paper claims on that same ounce through ETFs, futures contracts, options, and unallocated bank agreements. As long as everyone keeps rolling over their paper contracts and not demanding physical delivery, the system functions smoothly. But the moment a significant portion of the market says, "Give me the actual silver," we get a short squeeze. And that's exactly what's starting to happen right now. Many investors own ETFs or futures thinking they're equivalent to physical ownership. But paper instruments depend on the very system you're trying to hedge against. In periods of severe stress, access can be restricted, settlement rules can be altered, counterparty risk explodes. You may receive cash settlements instead of metal at unfavorable prices. Those who believe they were protected discover their ownership was conditional. Gold and silver are sought as protection against systemic failure and currency debasement. But if you own them through paper instruments, you're still betting on the stability of the system you're trying to escape. Mistake number 3. Speculation instead of insurance. Gold and silver are not designed for short-term speculation. They don't produce income or rapid returns. They function as insurance, protection against long-term erosion of purchasing power and systemic risk. Insurance doesn't feel rewarding most of the time, but it proves its value when it's truly needed. Treating precious metals as insurance means sizing positions appropriately, not over-allocating, expecting volatility without emotional reaction, holding through uncomfortable periods, never using leverage, which removes time from the equation. When you understand silver as insurance, price fluctuations become less emotionally charged. You stop checking prices every hour. You sleep soundly knowing you're protected while the system around you changes. Part 4. The 4 fundamental drivers. With those warnings understood, let's examine why silver's fundamentals have never been stronger. Driver number 1. Institutional buying just starting. Right now, institutional investors, sovereign wealth funds, pension funds, major mutual funds, hold only 1 to 2% of their portfolios in precious metals. Here's the math that should blow your mind. If these institutions increase their allocation from just 2% to 3%, 1 percentage point, the amount of dollars involved is so massive that there literally isn't enough silver in the world at current prices to satisfy that demand. Bank of America recently published new guidelines recommending 30% in hard assets, up from the traditional 20%. That's a $2 trillion demand shift across the global financial system. Since you can't print silver, that demand translates directly to higher prices. Driver number 2. Industrial demand is structural and growing. This is what makes silver fundamentally different from gold, and different from previous bull markets. Silver is critical for solar panels, electronics, electric vehicles, AI infrastructure, 5G technology, and medical applications. The green energy transition alone requires massive amounts of silver that cannot be substituted. More silver is being consumed than mined, and this disparity grows every year. Even if silver crashes 40%, industrial manufacturers would support a recovery because they need this metal. This demand doesn't disappear during recessions. It's structural and permanent. Driver number 3. Basel III and coming HQLA status. In July 2025, gold was reclassified as a Basel III Tier 1 asset, meaning banks can now count it at 100% value on their balance sheets instead of just 50%. The next step, which many experts believe is imminent, is classification as high-quality liquid assets, HQLA. This would allow precious metals to be used as collateral for loans and infrastructure development, just like U.S. Treasuries are today. This single regulatory change could unlock trillions of dollars in new demand as countries use gold and silver to fund development without ever touching the dollar system. Driver number 4. The BRICS parallel system. China and the BRICS nations, now 12 members with 17 more on a waiting list, have built an entirely parallel financial system called the Gold Corridor. This network of gold vaults across BRICS countries allows them to trade without using dollars, settle accounts in physical precious metals, and bypass Western financial controls entirely. When Jim Rickards was asked when the BRICS currency is coming, he said, "It's already here. It's called gold. Where gold goes, silver follows, but with more explosive percentage potential due to its smaller market size." Conclusion: what you need to do now. Let's bring this all together with clear, actionable guidance. Silver is experiencing historic price action, potentially heading toward $200 per ounce according to leading monetary experts. The fundamentals: industrial demand, institutional buying, Basel III classification, BRICS realignment, and physical shortages are stronger than ever before. Gold's 50% surge is flashing the exact warning it gave before 2008, 1980, and 1973. We're in a late-stage debt cycle with the first debt-to-GDP ratio above 100% in peacetime history. Central banks worldwide are dumping dollars for precious metals. Here's your action plan. Own physical silver, not paper promises. The 100-to-1 paper-to-physical ratio means ETFs and futures carry massive counterparty risk during systemic stress. Treat it as insurance, not speculation. Size your position at 10 to 30% of your portfolio, depending on your risk tolerance. This allows you to hold calmly through volatility. Prepare mentally for corrections. Even in a bull market heading to $200, expect 20 to 30% pullbacks. These are normal and healthy. Disciplined investors use them to accumulate more. Never use leverage. Leverage forces liquidation during volatility, often before the long-term thesis can play out. Many investors who are right about silver still lose because they're leveraged at the wrong time. Maintain diversification. Don't put everything into silver. Balance across assets that respond differently to various economic conditions. True resilience comes from balance, not concentration. Store it securely. Physical ownership requires planning. Consider secure home storage, bank safety deposit boxes, or specialized precious metals storage facilities. The critical mindset shift. Even if silver experiences a massive 40% crash from current levels, it would still be priced dramatically higher than mid-2025. The structural shortage and industrial demand make this fundamentally different from past bull runs that crashed and stayed down for decades. This time, even after a major correction, silver would likely recover steadily because industrial demand continues growing and the supply deficit keeps widening. The bigger picture. The world's largest economies are preparing for a post-dollar future by hoarding physical precious metals. What do they see that most people don't? 99.9% of people will lose money in this environment, not because precious metals fail, but because they buy emotionally, chase paper promises, or panic at exactly the wrong moment. Don't be part of that 99.9%. Final thought. Gold and silver have survived every fiat currency experiment in human history. They've protected wealth through the collapse of empires, the failure of currencies, and the repeated mistakes of governments. They're doing it again right now. The difference between those who are protected and those who lose everything comes down to one thing: understanding. When you truly understand how the financial system works, how debt grows, how money is created, and how power responds under pressure, you stop expecting silver to make you rich overnight. Instead, you allow it to quietly do what it has always done: protect wealth while the system around you changes. The warning has been given, the pattern is playing out. The only question is, are you positioned correctly? If this analysis gave you clarity, hit that like button and subscribe for more real financial education. Drop a comment with your biggest takeaway or your silver position. This isn't financial advice. Always do your own research and consult with qualified professionals. But remember, by the time everyone sees what gold and silver are screaming about, it will already be too late. Thanks for watching, and I'll see you in the next one.